I was listening to a talk on the first day about outperforming in liquid token markets. But one of the panelists were arguing that the opportunity is actually could come in more from public equities who utilize blockchain technology on the background. So I do think there is some risk that, and I'm going to use the word Web 2, even though you hate it. There's a risk that Web 2 comes and, eats our proverbial lunch in the sense that they, they just use all of the decades work of open source free technology that we built.
The Gore tweet.
Yes.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another episode of 0x Research. Today, we're live at DAS right after the Trump talk to chat with Carlos and Marc. Thanks for coming on, guys.
Well, you kind of forced me to be here, so.
Yeah, we didn't know we were doing this, but
Very good. It'll be
pleasure to be here.
You guys are both very tokenization and real-world asset focused. I would say it's much more relevant that you guys are here as opposed to me. What do you think is the takeaway for you, both, in terms of institutional adoption, in terms of tokenization, in terms of real-world assets? Marc, you can start off maybe with ETF stuff, asset issuance, asset management. What do you think?
I think, it's a good time to be talking about ETFs. We had like 5 weeks of straight outflows, but like this week, I think I saw over $500 million into inflows just into the Bitcoin ETFs alone. So very happy to see that turn around. Largely, I think tokenization, I'm walking around talking to some people here, and it's becoming a topic that people are more interested in these days. And they're actually asking a lot more technical questions than they were a couple of years ago. So, then there's other talks today that are going to dive into that deeper. But overall, I think, one of the talks yesterday mentioned that we're educating again as a space. There was a couple of years after FTX where we weren't educating, but it's starting to happen again. And I think that's partly what DAS is about too. And so it really resonates me to see that people are asking these questions again, and we're moving back to where we were previously.
Anything to add, Carlos?
Yeah, I think outside of stablecoins, just moving into the data, tokenization is really small today, like less than $20 billion in assets tokenized. Most of it is concentrated just in private credit and US treasuries, I would say 90% of it. So when you look forward, I think the biggest issue we have right now is regulatory, not technological. I think the foundations are there for tokenization, but the biggest issue is what are the right regulations to enable on-chain asset issuance, because what you have right now is basically legacy rails, and then you tokenize that and just add a digital twin, and the problem is you're just adding cost. You're not making anything more efficient.
That makes sense. I have two questions about this. One, why is it mostly private credit? Because I've heard this from both of you before. Why aren't we getting other forms of real-world assets on-chain?
I think let's just do the short answer. The short answer is mostly private credit, because most of the private credit is being issued on Provenance, which is a Cosmos blockchain with a validator set, semi-permissioned, but it's HLOC loans from Figure, that's basically mini home mortgage loans, but most of that is being issued by Figure because they've basically had to dog food them own selves, because they had to prove to the market that this technology works, and then in doing so, that market of these loans got successful, and so they've proved to themselves that they were successful, and hopefully that kind of resonates with the market, and so that's why I think that private credit is probably the most popular. But then also you want to do these less liquid types of capital on chain, because that's where the greater benefit is. It's so much easier to tokenize stocks. We have maybe not in the most legal sense or the most regulatory clarity, but you can get Tesla and Apple on chain. I don't know what your rights are to it.
It's also very tough.
you can't put size in.
No, you can't. Yeah, you can't put size, and that's a liquidity issue,
Yeah.
and that's kind of what I'm talking about too. So like they want to put private credit, and maybe private equity on chain to kind of bring that liquidity that doesn't really exist on traditional rails, and that's basically a long answer. But Carlos, if you have any thoughts.
No, I largely agree with that. I think the biggest benefit of tokenization is for sectors where you have illiquid markets. And so private credit is an instance where it is not publicly traded. Like the borrowers have very drastically different terms amongst themselves. So it's not standardized at all. So with tokenization, you have like a secondary market where you can add liquidity, but you also have like more transparent terms that you can track on chain. So it makes a lot of sense for that specific asset class. If you look at other things like, I don't know, commodities, like tokenized gold hasn't grown at all like in the past year. And I think a big reason for that is that you already have very liquid markets on like the traditional vehicles like ETFs. Like you look at GLD, it has like $86 billion in AUM, whereas like the whole tokenized market is just like $1 billion. And the reason for that, there's just no need for like a tokenized version where you can already get that like via an ETF.
What would you guys say is the best way to get exposure to real world assets or to tokenization?
Well, even on Carlos's point with commodities, something I think is interesting is Baxus on Solana, basically using NFTs to represent whiskey. And I think what's great about that is that as maybe a whiskey collector or trader, you go to this website and you don't know that it's running on the Solana blockchain or any blockchain at all. So it kind of abstracts away all of that. But that is an example of something that's directly issued on chain through these NFTs, something that we think is just meme coins and art, and it actually has a tangible use case as backend tech to represent something that's non-fungible. And I think it provides liquidity to a market that may or may not need it. I'm not a whiskey expert. I'm sure other people would really appreciate this instead of having to drive miles and send in a mail order check or whatever it is they do in America. They still use checks here and sign things, right? So and then on that same point, I see uranium on the blockchain now.
I remember that.
Yeah, I wanted to try and sign up, but I had to KYC and I wasn't really a fan. But I guess anybody buying uranium probably needs to be checked.
Yes, you should be checked if you're buying uranium.
So I do think like, okay, these are maybe novel and niche use cases, but the greater point is that they didn't exist before. Like you're expanding the total addressable market for different assets, and in this case commodities, to be traded, yes, on chain, but just to be traded in general.
Yeah, I agree with that. I think that one of the greatest opportunities is just tokenizing private equity. There are firms that have done that, like Actionariat, like in Switzerland.
Yep.
But the problem is that it's very like limited, like geographically.
It's only for Swiss ones as well because
Exactly.
of the law, right?
It's just like small to mid cap Swiss equities. I think you wrote about it like 2 years ago, maybe.
Yes.
Yeah. Yeah. But like, it's just very limited today. And I think like players like Robinhood have demonstrated like interest. Like I think Vlad mentioned, like the co-founder of Robinhood, like he's very excited about tokenizing private equity, that there's no fundamental reason why someone should be able to invest in like a 5-minute old meme coin, but you shouldn't be able to like invest in SpaceX or OpenAI. So I think that's one of the areas where I'm very excited about it. But you need like clear regulation, especially in the US, which, whether we like it or not, is the most important capital market in the world. So you need like regulation here to be able to onboard like billions of assets in tokenization.
Completely agreed. I have one follow-up to this question. I've been hearing and seeing more and more blockchains that are permissioned that are coming out now and saying we are specifically built for this. And comparatively, we've had existing blockchains that are more popular, that already have the tech stack. Like I'm thinking Solana, Ethereum, L2s, and then now I'm thinking like there are specific ones that are being built that are permissioned, private validator set. And we also kind of saw this with the earlier real world asset exposure. So I would say like MakerDAO, especially like Late Bull was very clear like a real world asset play because they held a lot of T-bills. Versus now, I feel like we're going to be getting more and more different things. Maple was also an older example. Now we have Ondo, Mantra, etc. How much do you guys think it matters if, I guess, like old versus new in this case? And do you think we're going to be getting drastically like different forms of exposure? Do you think we should focus more on like private equity opportunities, or do you think it's like a picks and shovels kind of scenario where I should actually be focusing on, let's say, like a permissioned blockchain?
I mean, just to like set the context, like we've seen tokenization players that already have like existing products expressed plans to launch their own blockchain. So you have like Ondo with Ondo Chain, that's a permission kind of blockchain. Athena, like 2 days ago, announced Converge alongside Securitize. What I found interesting about this is that Athena already has like a very popular and big tokenized product, which is USDE.
Yeah.
And what they want to do is like bridge the gap between like institutions and DeFi. So it's not exactly like purely focused on tokenization and RWAs, but it's more like how do we make sure we can give like compliant access to institutions to products like USDE. And I think that's like a great like use case for like a permissioned kind of like blockchain where it's like very focused on like specific use case and you have a very clear idea of what you want to achieve.
Yeah, I agree with that, and I also think it's even broader because, like, if you follow the incentives, yes, Athena wants to do this, but has their own chain, so does Ondo, but Hyperliquid, similar.
Thank you for that.
Hyperliquid wants to have their own L1. We've seen this with many other, like DYDX. We've seen this with many other protocols or companies just wanting to capture more of the value stack, wanting more control, and I think that's a key word there, the control, because that's something especially these financial institutions will want when they're issuing assets, control. So does their own permissioned blockchain provide them that? Yes, but then you have to look at what the trade-offs of that are. It's not easy to run a permissioned validator set or even run our own blockchain.
You open yourself up to a lot of legal risk as well, potentially.
Yeah, legal risk, smart contract hacks. I mean, depending on how. I mean, you can roll it back, but then what's the point? Like, why not have it in your own private database? And then when we start to have all of these varying institutions launch their own private chains, then we're going back to the same problem that we had in the beginning, because all of the private equity right now probably exists in a MongoDB or somebody's using Cobalt in a bank to just store this, or God forbid an Excel file, right? So and there's no shared liquidity.
God forbid it would be QuickBooks, no?
Probably. Yeah, and there's no shared liquidity. There's nobody can tap into this. So when you have all of these L1s, we're kind of going back the wrong way. And I thought we did this blockchain, not crypto movement years ago and learned from that. But, I don't want to name drop anybody, but we've seen some failures in this space. On that note, and I know y'all might not agree, but there is a hybrid approach to this, which let's just say in 2 years, Ethereum solves interoperability between L2s. Right? Right now, we're comfortable, or maybe not comfortable, with L2s having their own centralized sequencers. I mean, Base is the most popular L2, and it's controlled by a centralized company, has a centralized sequencer. So, in terms of L2s, I don't think that's an issue for the market, relatively speaking. So there is a scenario where these institutions can launch their own L2s, under the same guise, powered by Ethereum and whatnot, and get some kind of control, whether that be KYC or you can roll back, have the centralized sequencer, while also tapping into the liquidity of other L2s through whatever means that Ethereum eventually solves this with. And we see companies like Deutsche Bank announcing that they're going to have an L2 with ZK Sync. So and the EY, Ernst & Young, has their own L2 on Polygon, Knightsbridge. So these are pilot projects, obviously. I mean, that's how it's always going to start. But I do see that as another way forward. There are other ways, but I'm going to just stop there and, if Carlos has any thoughts.
Yeah, I guess you have that in various ecosystems. You have that, for instance, with Avalanche subnets, like the Evergreen. I don't remember the name, but like it hasn't seen great traction. The problem is if you're like a bank, do you really want to launch an L2? Like, do you have like the expertise to do that? Like, do you want to run the infrastructure? Like, they're not like prepared to do that. Like, I think it's more much likely that you see models like with BlackRock where they just do the thing they're used to, and they use tokenization providers like Securitize to wrap their like their whatever products they're offering and put them on the blockchain.
I think that perfectly encapsulates the two approaches as well, like the Avalanche and Ethereum L2 approach, where it's like they want to own the full stack, so we should allow them to own the full stack, give some form of decentralization. And then the other side is, like, to me, it would make more sense for them to, like you said, to launch some wrapped fund on a chain where they can also get the other liquidity benefits as well. One thing that I've been asking, and I've been hearing some complaints about, is the fact that we've become less and less cypherpunk and a bit more institutional. And I think this was kind of always going to be the case. Like, I expected this, and it's been going kind of towards that direction, like more centralized validators, closer co-location, smaller sets. And now, like, we're getting with Fogo. Carlos, I know you just wrote a report on them. Fogo's just doing 21 permission validators across like 3 major cities. And increasingly, the only use case for crypto is that it's better for settlement. Like, it's T0 instant, or 20 minutes, whatever it is. Are you guys happy with that? Are you guys sad with that? Mark, I know you're very passionate about this.
I think, like you, I think I thought this was inevitable. You've seen this coming. You know, when I read the Bitcoin white paper, that whole cypherpunk idea is kind of what initially caught me. But I think, you know, as you start to opening it up to more mainstream, you're going to lose some of those core values. But I also think that's almost kind of the point. Like, this is a decentralized system. It's permissionless. You have permission to be permissioned if you'd like. You can build whatever you want. Just like people were criticizing maybe Solana for building meme coins. Like, that's what people wanted to do. People wanted to trade meme coins. People wanted to use this technology to do that. And now, as we're gaining greater adoption, people would like to use this technology to create less decentralized applications. And I don't think there's anything inherently wrong with that, you know, because it's supposed to be permissionless. And I have been of the view that, you know, it's not going to be DeFi, even though I never truly thought it was, given that it's kind of like it's on-chain governance, and it's really, you know, who was early in the team, which rooms were you in, how much money do you have to buy these tokens, what's your tokenomics. That's not, you know, that's a different version of control. But I've been of the opinion that it's not necessarily great, hasn't been DeFi, isn't going to be DeFi, it's more on-chain finance. And you can have permission to go on, you know, use the less regulated things if you'd like.
Yep.
Right. But I think a lot of people would feel more comfortable if there was some backing behind it, some kind of reputational backing, maybe some kind of more centralized control.
Yeah, I agree with that. I think that the majority of the world, like in 5-10 years, will be using like permissioned kind of networks in some way or another. That being said, it's sort of like the right to bear arms, or the right to free speech, like in the physical world. Like, you don't think about it often, but like there are times where it is needed, and you always need to have that optionality to be like on a permissionless blockchain. So even if most of the world doesn't use it, you still, like, it's a fundamental right, and it's something that we should strive and fight to keep. Same with private money. It's something that we haven't paid much attention to. Like, most of, like, all public networks today, like, are by definition very transparent, and firms like Chainalysis, Arkham, whatever, can track everything you're doing. I think private money is also one of the things that we have like neglected for so long, and we should like try to pay attention to that.
Can I just say that even now, and I definitely agree with that, maybe they amend the constitution for public blockchains, give them some more rights. Can I just say, even now, I'm trusting the manufacturer who made my laptop, the manufacturer who made the hardware ledger. I'm trusting the audit firms. I'm trusting my wallet provider. I'm trusting the RPZ network. All of these are centralized entities along the way. Like even like for Bitcoin, I'm sure none of us here have actually audited the actual script that Bitcoin code is written in.
You don't know that.
Well, I'm sure the two of us haven't done that, or the majority of people. So there I think trustlessness is a meme. Like at some point or another, you have to. There is some level of trust, and it's always going to be in another human being, whether they built the tech, audited it, or you're currently providing a service. There's always going to be some level of trust along the way, and the benefit of this technology is that it just opens up the spectrum for this.
I completely agree. I imagine it'll be like the internet where there are places where you can do whatever you want. And then there's the very normie safe, traditional part of the internet. And I think that's likely what it should be like. Like, you really don't want people to be doing whatever they can do on public. Probably just because they don't want to. One thing I will say is that what I hate saying Web 2, but let's say traditional applications know how to do is building out good UX, and that's something that I'm actually excited about. I feel like we just can't do it because we have to deal with the back end stuff, but if these guys can just like they're better at UX, they're better at front end. If you've used Robinhood and if you've used like any other app, Moonshot, you can tell there's a very clear difference in how good it is. Slingshot is pretty good, but apart from that, like I can't think of any good UX. So that's one thing I'm excited about. Do you guys have any big DAS takeaways?
Well, there's one on the same topic you just brought up there. Web 2 is UX. I was listening to a talk on the first day about outperforming in liquid token markets. But one of the panelists were arguing that the opportunity is actually could come in more from public equities who utilize blockchain technology on the background. So I do think there is some risk that, and I'm going to use the word Web 2, even though you hate it. There's a risk that Web 2 comes and, eats our proverbial lunch in the sense that they just use all of the decades work of open source free technology that we built.
The Gore tweet.
Yes. And just put a better wrapper over it, or like and wrappers aren't bad things, like ChatGPT wrappers, just because you're just using underlying technology with a better interface, right? So I don't want to dismiss something just because it's a quote unquote wrapper, but that really opens up the possibility. Like I'm looking at neobanks in Brazil who are using blockchain rails as part of their payment rails, as one part to like move money around, remittances. Like these companies are tapping into this tech, and the users don't care, they don't know, and maybe the shareholders of public equity companies might be able to benefit more than you buying the third highest TVL DeFi token on some whatever chain.
Yeah, big takeaway for me, I think we already mentioned that we're exiting like the cypherpunk era, entering like the mainstream era of crypto. Institutions are already here. I think over the coming months and years, it will be crucial to have like very clear regulation, especially when we talk about tokenization. You need to make sure like there's a way for having like this parity between like the digital twin and the physical twin, like making sure that when you transfer a token, you're also transferring the right to have that token in the real world. And aside from that, you need to think about how to bring like the benefits of crypto to like a wider audience in emerging economies. Like you need to think the on and off ramps, things that we don't think about often, I think are very important problems to solve in the coming months.
Before your next question, I realize we're kind of leaning very heavily on this centralized stuff, and I just wanted to say I'm very still supportive of decentralization, and just because I'm wearing a suit, okay, please defend us.
Yeah. I will say I had to do this last time we were talking about it, and you were like, oh, meme coins are great for Radium, and they were great for Solana, and like I had to give a caveat that like you don't have a moral, like you don't care. It's about what, like you're an analyst, you care about what makes companies money, and that's generally, like I'm not very happy about centralized. I think people who know me will know that I'm not like a huge like centralized person. But but you have to go where the puck is going. I think that's the way you say it. I'm not sure. I don't play hockey. What I wanted to, my big takeaway was, well, I had two. One was I need to figure out a way to get exposure to stablecoins. As in not like buy stablecoins, but and I think the only way to do that is Plasma. Ethena is a good shout, actually. I just don't know how much leverage Ethena has in like the important conversations compared to Tether and USDT and Plasma, or like if Circle's IPO. I guess I don't know.
Yeah, one of the things that I like that Ethena is doing is they identified that, for instance, with USDT, one of the big use cases for USDT is just being margin on centralized exchanges and onboarding that as collateral. And I think Ethena is doing a great job. I think they already have they're already supported by the major centralized exchanges, and they're just keep adding utility to USD. I mean, if you have like a US Treasury rate that, I don't know what it is set right now, like 4-5%, whatever it is.
Why didn't you ask me?
Because I don't know. And then you have like SUSD offering rates at 10-15%. As rates come down, like in the traditional world, Ethena becomes a lot more attractive. And if you build the infrastructure that allows institutions to easily get exposure to that yield, you can have a lot of inflows there.
Are you worried about the risks that come with Ethena?
I think they've solved the main vulnerability of USDE, which was what happens when you have periods of negative rates, like prolonged periods. And they launched like USDTV, which is allocated mainly to BlackRock's BUIDL.
Okay.
And then in periods of negative funding rates, what they can do is then they can close the purse positions and reallocate to USDTV so that they can act as like a stabilizer for the stablecoin.
USDE is a fascinating case of financial engineering where you're basically buying into a fund. It's a fund.
It's essentially one of the best use cases of tokenization.
Yeah.
They're tokenizing like a very complex financial strategy that was accessible to just a few people, and they're like letting everyone just have access to that through a token.
I'm increasingly seeing competitors that want to say our like edge is that we don't really want to do the SEC stuff. We just want to do permissionless DEX. And this is something UXD did before. I don't know how familiar you guys are with UXD. And it just couldn't scale. But like you said, Ethena has been doing fantastic. They actually bought a ticker on Hyperliquid. So I assume they're going to be also launching a Hyperliquid for centralized, not centralized, decentralized exchanges, the big ones. But yeah, they've been doing a fantastic job. Have you guys looked into Plasma or no?
I have not. I know I'm familiar like with the relationship with Tether, and like it's supposed to be a Bitcoin sidechain or something, but I'm not very like clear on that.
No, I just remember UXT. I remember thinking Ethena is what UXT wanted to be. I was somewhat optimistic on them solving the stablecoin trilemma for decentralized stablecoins, and it never really kicked off. And then it so ended up being that a more centralized version of this was actually better and higher rewards. So show me the incentives, and
There was a talk right before the Trump talk that talked about sufficient decentralization, and I feel like we've gotten that a few times this year. Ethena UXD, Hyperliquid, I think is a fantastic example of like sufficient decentralization. I think likely going forward, a lot of people are going to have to make some moral and ethical and ideal concessions and say, you know what, like the Trojan horse metaphor, this is what we have to do. At least I have a potential like fire exit if I need to do it, and it's a little bit better than centralized. But we're gonna have to change a lot of our mindsets.
I mean, we're even seeing Web 2 go the other way too, with Meta's Threads, which basically Twitter clone, X clone, that runs on a distributed decentralized server, and it allows specific regions or jurisdictions to, this is not going to be a popular take, but it allows them to censor for that specific area.
Yeah.
So that and remove the liability from Meta's
Very
threads.
good.
So it might not be morally the right approach to what they're doing, but they're using the technology for approach that benefits them.
Yeah, like going back to the question of how to get exposure like to stable coins. I think, yeah, I agree with you. Like Athena is a big one. I think money markets could be another one. Like if you think where stablecoins deploy today, I think money markets are one of the primary beneficiaries in terms of inflows whenever you have big
Yeah.
spikes in like stablecoin supply. Think Aave, Camino, like make your choice. But like I think money markets can benefit greatly, especially if they can offer DeFi rates higher than the ones offered in traditional finance.
Perfect. Okay, guys, thank you so much for being forced into doing the podcast with me. I really appreciate it.
My pleasure.
Yeah, my pleasure.